means you offset it wherever the premium is stopping. That's what
I'm just offsetting. In fact, I didn't do not a reduced paid up because then I'd have problems with pulling money later too. No, I just offset it, just an offset. Okay? All right. Good? Okay. So you'll want to pull that up before you start so that you'll have it in the case file as you go forward, is my point in that. And we're going to put in this case for Sam and Sue.
So start in your notes and use the names so we can all chat about them.
We're going to illustrate to age 70. They're going to retire at 70. Current age 35. Mortality age, and let's put 100. Spouse current age 35. Mortality age 100. All right, so one of the things that we have in asset flow, everything above this line is global. It affects all of the other assets. Everything below the line is for that particular asset only. Now, we're going to change this. Naming the accounts is helpful. So on this first one, we're going to call this money market.
Okay.
So earned income and Social Security. Okay, we have to include it. Starting age 35, wages 65,000, end age 69. We're going to inflate that. Now, when she turns that on, what you're going to see is nothing actually happened. And the reason is the inflation here is tied to this earned income so that we can toggle it on or off globally. We have to have that turned on up there, and we have to have an amount. We're going to use 3% for inflation, and now we see that grows by 3% a year. Does that make sense? The default is to include taxes, FICA, Medicare, and that is a problem. No, that's good. Okay, so what happens here is, why do I have capital gains tax in here as an option?
Because it could be income.
Right, it could be trust income. And so if somebody's receiving income from a trust, what happens often is the trust transfers the tax liability in the standpoint of their capital gains liability on that portion to the individual. They're not paying income tax or FICA, but they're paying capital gains on it. It depends on what the investments are. They can transfer whatever it is. If it is at the regular, then we would just have regular income tax. But if it's all going to be capital gains that they're shifting off the trust, then that's all they're responsible for. Okay, our standard tax deduction, if we put a 0 in there, then things that are tax deductible, it automatically knows if there's a 0 in here, then use our mortgage deduction, use charitable deductions, any of those things as part of the deduction. If I put a number in here, it's going to automatically exclude mortgage deduction and everything else.
So that's going to pull from the real estate calculator?
Yes. Yes.
Are you going to have to use the expense tab and put in
charitable? Yes.
Put property tax in there too. So anything we put in the deductible section will then calculate it.
Correct. Does that make sense?
And you're seeing that most people have seen that 30,000 new number?
Right now, I think it's an easy job for the CPA, quite honestly. And I think they're pulling the triggers like, with 30, what is it now? It's 31.5. They just changed it in September. It was 30,000 for 2005, but I think in September it changed to 31.5 for 2025. So we can put in 31.5, but what we see a lot of times is, let's say somebody's got charitable deductions that aren't enough to cross over the 31.5. They got mortgage deductions that aren't enough to cross over the 35. So people are just pulling the trigger on the standard deduction. Wait a second, those two together will cross over.
So if you go to expenses and you put stuff in the deductible bucket,
Let's stay on track.
Well,
Right,
no,
so make sure
yeah,
where it goes.
yeah.
So that's where it would go.
Exactly. Yep. All right?
I do not have taxes on. Do you want taxes on?
Not yet.
Okay.
And the other thing is that we have to be sure on each one of them, they default to the asset being turned off or not included. That way we can look at putting them on, putting them off. And you know that because of the blue box up there in the, if we turn on include, now it's got a green bar around it like expenses, then you'll see that the earned income has green. It's being included in there. So we can toggle those on and off to be able to see what impact they have. Or because, hey, they're not going to do this one, let's just pull that one out.
Do you have a spreadsheet with this so we can import, or do we just?
Nope. There's two schools of thought here, I think. And so a lot of times what I'm going to use with the client, I'm going to ask them, what are your expenses? They're going to put something in there. I'm going to put them on here, and then we're going to see if it's actually that way as far as just a total. For some people, it's very helpful, and we'll give them a picture of this, go fill this out. And they're going to go through there and say, we had no idea we were spending X on this or that, and we're cutting that out. And so it can be helpful from that standpoint, but I think it's also can bog down the process. So you just have to weigh that based on your relationship with the
Trying
client.
to save time.
Yeah.
by taking this.
And we have a fillable PDF.
Yes.
You?
Can you check if that's on the bonus downloads? So if you want to give it to them with fillable PDF, it's not going to populate this, you'll still have to populate it, but.
Oh, okay.
at least
But they
it's-
could fill it out.
At least it's the
Yeah.
right order and it's
Yeah.
fillable and that part's
Okay.
done for you.
Yeah.
Okay. But you still have to do this by.
Yeah. And here's the deductible. Oh, so Danny, yeah. Anything we put in here is going to be deductible if we have a 0 in standard deduction. Uh-huh.
If the standard deduction is 0, would it take from the real estate and take it, or no?
Yes, so look at real estate in one condition. If we say that's a tax deductible loan. If it's turned on as a tax deductible loan, then yes, it's going to take that as a deduction.
Oh,
Good. In the real estate, if we have the loan as tax deductible, whether it's personal residence or whether it's investment, if it's investment, then it is going to deduct it even if we have a standard deduction listed. If it's personal residence and we turn this on, it's only going to deduct it if there's nothing in standard deduction.
Where does it specify? Whether it's personal or,
We have personal residence option.
oh, thank you.
What about property taxes? Will it pull that in automatically?
We can put property taxes here, but it's not going to deduct property taxes.
Okay. So that has to be put in the expense.
No, okay. Personal property tax is not going to deduct. If you put it on the real estate page as investment real estate, yes, it will deduct the property taxes.
So if that's not checked, personal residence.
And for clients, a lot of times, all they have is their personal residence. I'm not going to put it here and add it to their expenses because it's part of that. Or I'm going to separate it out and get more granular and go in and put all the specific pieces. It just depends on the situation.
So your question is to the client is, do you itemize or do you take the personal exemption?
And there can be times we can switch that and see what happens between the two. See, that's the beauty of asset flow, and I think that's where it's really helpful for you as advisors is to be able to say, hey, behind the scenes, let's put the deduction in there, let's take it out. Hey, look, you know what? We could actually, in our holistic approach with our client, is talk about maybe some tax strategy that's going to help the bottom line long term. Does that add to your commission? No, that's part of what we're doing.
Taxability and deductibility are not of certain expenses. Is there somewhere where we can see whether that's happening? Whether, for example, property taxes are being considered as a issue? I'm not saying the rules, I'm saying the software. Whether, say, I marked it personal residence and I shouldn't have, and I didn't realize it.
It's going to treat it that way.
Board that'll tell you.
No, not really. And maybe it's something we need to think about, but yeah. And it's funny, what happens is, at least for me, the more I use it, you start to understand how stuff's going to react, and when you'll see something, it's like, oh, wait, something's off.
Got it. Thanks.
Quick, last question, when you click self-employment, what happens to the math?
What happens in the math is when you click on self-employment, it's going to take, instead of 7.5% or 7.62, it's going to be 15.3.
That's right.
Is there a way to
Include the standard deduction?
Yes, and we typically do. Let's put 3% on the standard deduction increase.
Thank you.
Yep. Thanks for pointing that out. Okay, normal retirement. So let's look at Social Security. We can turn normal retirement age off and then put just a flat amount if we want to calculate the benefit and do that's fine, but whatever the first year is, but I don't ever do that. So normal retirement age for them is going to be $36,000. Sorry, $32,000. And let's take it at 70. So what happens here, and let's put a cost of living, we're going to use, it's interesting what happens with the cost of living on Social Security. If you go back, now in the last 10 years or so, it's been weird and more in the 3% range, more like 2.7 or 8. But if you go back like 50 years, what's weird is the benefit before you start taking it has increased by about 3%. When you pull the trigger and start taking it, it's about 2%.
The adjustment, if you don't take it, is larger than when you start taking it.
Yes.
Only up until age 7.
What I'm saying, but even afterwards, yeah, once, yeah. So go ahead and put, let's use 3%. We'll just, and spouse 32 as well.
Todd, one thing about the benefit amount, at age 67, the full retirement age, using the PIA works the best. Because depending on when they retire before age 67, Social Security statement will give you, they will estimate working with the same income until age 67, and that's the number that they show on the statement. So
Even though they didn't do it.
If somebody's retiring early or making less, that estimation will be slightly wrong. So using the PIA would be the best, most accurate number.
Okay, great. Okay, so let's scroll down.
Can I ask another silly question?
Yeah.
Client says, why would I wait? I want to take it at 62. My dad says this to me. Isn't it better to have dollars now than later?
Okay, there are times when it might be, but if we scroll down, look what their Social Security benefit is at 70. So it's $111,000. If we take it at 67, then the amount's $82,000. And it's not gonna, it only gets to $90,000 by age 70. So I could take 111 increasing from that point out, or I could take a smaller amount that's going to keep it smaller all the way out. Now, if I died at age 68, I should have taken it early. There's going to be a crossover point. It might be 10 years out, it might be 15 years out. You could run some numbers and see if you had it invested at a certain opportunity rate net, where is that crossover? Am I going to live that long? Nope. Okay, I'm going to take it early.
I find that there are multiple factors. One of them is how long they anticipate to live. Another one is what's the circumstance at 62? If their intent is to retire at 62, it is.
And one of the things that happens a lot of times, think about this, let's say they've got a lot of qualified money. Now, my take on it is the opposite of what any CPA is going to be. CPA is take that till the last, right? We want that tax deduction as long as possible. No, you don't want to pass the qualified plan. I want to pay that first and leave all my taxable assets for later. So what happens is if I push this off and I pull out as much as I can from 60 down to that point, my tax bracket is going to be way lower than after Social Security starts getting in the mix. So I might want to pull that to compensate for that differential and have the qualified plan do what it was sold as to put you in a lower tax bracket. I might actually do that if we watch how that happens with Social Security. Okay? Good on that? Questions on that? Make sure that your notes are good for what we have here because we need to make it all match. All right, and then let's go ahead and put taxes in so we can see what that looks like. We didn't turn on the spouse. Include.
And this is what you mean by.
Yeah, let's turn on income taxes. Now we can see here's income taxes on that. Based on the 2025 married US tax brackets, no, we don't have Puerto Rico in there yet. It's a little more complicated than the US ones. We'll get there. I've just got to get cleared up, and I'll be making some phone calls to, yeah. Okay, yes, we can put all of the provinces of Canada in there for Canadians. Just pick one of the Canadian ones and see how awful that is. I had a guy in class one time, he started laughing when we were talking about taxes. I said, what's the deal? He said, you Americans, you have no idea what tax is like. All right. We can increase the tax brackets if we want to, as far as so it's gonna adjust where the brackets happen. Let's go ahead and adjust those. Yes?
On that one, the new regulation capped it, but the amount is not going to increase after on the 22% and above brackets.
Oh, really? How can they?
Inflating for most clients.
Okay, we won't put that in there. That's pretty interesting. I did not realize that. So they actually put something there to say don't inflate that anymore? What does it take to change? Is it just to change it? Like if the next administration comes in, could they say, oh, we're just going to scrap that and now then you can? Or I guess it has to go back through Congress.
Sorry.
Cool.
To get to that bracket is not going to increase any more in dollar terms.
Well, that makes my job easier.
As of right now, is it a permanent part of the tax code, or is it just nothing permanent? Timeline.
That's right. Okay.
Yeah, as permanent as.
Cool. All right. The other thing that you want to be careful of is when you're putting the taxes in here, is go ahead and put you a capital gains rate. What happens is if you don't do that and you find out later, everything that you've done along the way is going to be off.
I do have a question on that.
Yeah.
So when somebody's income does drop to the 0% at some point in the future, does the calculator detect that?
It keeps it at whatever rate we have in here.
If there is a way
Okay.
to say from year 1 through 10 is 15, but from 16 and beyond is 0, would that be possible?
Yeah. So maybe we need 3 spaces in there. It's going to be this for this section, this for another. Yeah, I know. But again, it comes back to that. Is it going to be simple or is it going to be detailed? I don't know.
It's a big amount of capital gains once the base is all taken out. There's a huge chunk that comes out at the end towards when you're spending it down. Like, it's a lot of taxes, but they're in fact a 0% capital gains tax.
Okay, cool. All right.
How do you speak to that inflate taxable income bracket, or is it relevant? Basically?
It's kind of relevant right now, but what that would do is, like, if we put 3%, wherever the brackets are between each of the layers, it would push that amount up each year so that more income would be at the lower rates. It doesn't change the rate, it changes the bracket. Yeah, the threshold.
I see, because it's like the deduction, standard.
Correct.
Deduction, they're increasing that. Okay. But it's irrelevant now.
Yep. All right.
You want state on?
Now, and what happens with the state? If we have state, then we get a deduction on the federal, so we pay less federal tax, but we pay more tax overall. Okay. All right. So we're good here. Let's go to.
If it helps you, you might want to snap a pic of this with your phone if you didn't take good notes, or even if you did. That way you've got all that data because you will be putting it in so that you get good practice.
It'd be great.
If we added some more boxes.
No, rather at least create a summary inputs. Like what was put into the system to kick off, like instead of having to look at all of this, like what he was just saying, maybe a little wheelbox summary inputs, and now we can see basically all the data we've been looking at without it already being set in the system. Like a nice printout. Because it would have been great for you to hand them out and then clear it so we know.
Yeah.
You see what I'm saying? Maybe you're like,
For all the inputs,
Take a picture.
that would be that's the tough part. Or you mean just,
system's already recording them.
Yeah.
when we start.
Because otherwise it wouldn't.
Yeah, but there's like 10,000 inputs, I think, all total, if you did every box, something like that. That's the only, and I get it, but that's the only problem. I don't know, but on some of them, like the income, it might be good as a starting place, and then, let me think about it, yeah. All right. And we put our money market in there. They've got $150,000 in there, adding $10,000 a year at 2%. So we're going to include it from age 65. We're going to put a payment in there of $10,000.
Age 35.
Oh, did I? Yeah, age 35. Sorry. We're going to, and we have to include it. 2%, and we can leave it's going to be full time, but actually only probably as long as they're working. So we might go ahead and put a 69 as the end age. It's important to put those stop ages because especially on qualified money, if we don't put it in there, it's going to keep assuming that it's going in there.
You see those two keys at the end that are in blue underneath the spouse mortality age where you can turn it on and turn it off?
Yep.
Just so you know, I can't barely see that. Is there a way to fix that?
Yeah, you can change the preferences.
Okay.
So under Tools, Preferences,
Okay.
and you can change what the system color scheme. There's a few in here, and you just have to try some and see what you have. Okay? All right?
You inflated the payment?
Nope.
No.
But we will.
Count earnings.
Yeah, so let's inflate the payment. And nothing went up. Why? Because our global savings increase is turned off and has 0 earnings on it. There, and we're going to increase it by 3%. Now it'll go up by 3%. So all the savings that we have in the entire system, if the inflation box is checked, will increase by this 3% number here.
That increase, so say if they had multiple money market accounts, increase all of them by 3%?
Only if we turn on the inflate. If we do, then yes. Everything in the system, whether it's qualified money, whatever, if the inflate's checked, it's all going to relate back to that by how much. If savings increase is turned off, 0. We'll get to those. Okay? Good with that?
I use this also heavily, this name section, like if they told me minimum was 100K or, either his name, her name, I put all kinds of stuff.
And that's actually what was here. They wanted an emergency fund of at least 100,000, even though they've got 150 in here. They also have some term insurance. I like to put the term insurance just so I know what it is on the far right. It doesn't matter what box you put it in. So I'm going to click on, I'm going to use 7 and 8 for their term insurance. And we can load life insurance data in here. They had 250,000 each. So I'm going to load it. And so how do I get 250,000 of that of this term down here, go down to the 30-year level term, if it's $1 million policy that I put into the system? I can go over here to interpolate. If that's on, nope, you turned it off. Then slide over here, I can set death benefit, I want $250,000 of that. And it's going to divide the premium
The life insurance
by 4.
fund.
Wait, go ahead and load it. Oh. Yeah, it's right here.
It's always there, every screen.
On all of the insurance screens.
Where's the insurance?
I'm in life insurance.
Oh, okay, thank you, I just missed it.
Yeah.
My fault.
Yep.
Sorry.
Okay, it's going to ask me, we'll adjust that. So the first thing, go ahead and do that again. Go back to load life insurance. Go to the 30-year term. We've already got it set to 250,000. That's good. So just go to the term, load it in. And it's going to ask me if you want to overwrite what's here, whether it's blank or not. It just wants to make sure you didn't want to pull stuff in over what you had. Okay, yes. And it's going to ask you what age you want to pull it in for the first year. Why? Because this may be a term policy that they bought at 30, and now they're 35, and it's going to go to the 5th year of what we put in there and then pull it down from that point on.
Is there any reason why you put box number 7 on life insurance?
Yeah, for me, I just like pushing the term to that end. It's just personal.
Okay,
I like knowing that those on the end are my term insurance, and I've got whole life everywhere else.
okay.
But no, it doesn't have, it can be anywhere.
Okay, thanks.
And we've got it included. You're gonna go ahead and put Sam's term insurance, and then let's do the same thing for Sue. It's already good, because you did it before.
Same one?
Yeah, is there gonna be a difference in him and her? Sure, but I did it all on overcharged. I did it all on mail rates, just so it was easier and we could get more things in here.
Super important to check spouse's policy when it is.
Yeah, so yeah, the spouse policy, what does that check mark do? That determines, like on death, when that money is going to dump into the estate. In other words, if we had her die early, it would be her policy that would come in, not his, or vice versa.
And I did notice the other insured, they
Yes.
didn't have that until recently.
No, it's been in there all along.
All along?
Yes, from the beginning.
Like the policy?
Yeah, so if we turn that off, then we have an other insured, like if we're buying from somebody else, and so it's going to really just attribute the cash values into, we're the owner of that policy, or we wouldn't put it as part of their assets. Yeah, and so this is what I would do. On this particular policy, this is a 30-year level that allows you to continue to buy it out at the end. We've talked about this in regular truth training. It's going to jump to 9,100. Probably nobody's going to do that. Just for your knowledge, that $9,100 is not charged to force you off the risk, which is what it looks like. What it is the actuarial cost for the insurance company to insure that one more year. If we go to another year, it means they undercharged for 30 years,